Once upon a time, there was a podcast. It was presented by two very likable guys who had lots of good ideas for new episodes. One day, they had a really good idea. They invited two colleagues, Paulina and Alberto, to come on the show and talk about equity stories and credit stories.
What's an equity story?
Said Allar.
And what's a credit story?
He added.
Wait, this sounds like a fairy tale.
Well, I've been reading lots of fairy stories to my daughter. Maybe that's why.
Personally, I enjoy thrillers. How about this? Paulina and Alberto burst into the podcast studio.
Quick,
said Matt breathlessly.
Press record before it's too late.
Both those stories get you interested in finding out what happens next. They make you want to read or listen right to the end.
Well, let's hope so. Do you think that's what an equity story and a credit story are about too?
It's time we asked our experts on this episode of A Dictionary of Finance.
This is a Dictionary of Finance from the European Investment Bank, and we're here today with Alberto Casorati and Paulina Brzezicka. Did I get that name right?
You got it
right. I get special
Polish
Polish points today for that, don't I?
Well, Alberto is an advisor in the Innovation Finance Division at the European Investment Bank who focuses on broadband and digital economy. Alberto used to work at Citibank and Intesa Sanpaolo in London in restructuring and corporate banking.
What does restructuring mean, Alberto?
Well, restructuring is usually related to a company that is unable to repay their debt and they need to renegotiate the terms of it.
Ah, okay.
He's also a graduate of Bocconi University in Milan. Everybody at the EBIT has special talents, but I think Alberto may be the only one who has worked as a baker, baking bread in a local bakery owned by his childhood friend.
Paulina is also a culinary type with special talents. She's recently been making cheese from freshly sourced cow milk. What kind of cheese does that end up as?
Just cottage cheese.
Cottage
Polish
cheese.
style, regular cottage cheese.
Oh, that's a particular Polish thing? Is that kind of cottage cheese?
It's quite popular, yeah.
Oh, do you have plans to move on to, goat's cheese, chèvre, or things like that? What's your story?
Try.
What's the story?
Business story.
Yes.
We will see. Maybe in the future I will branch out.
Okay, we'll follow that.
Paulina is also a graduate at Bocconi University. She has a double master from Bocconi and Vienna University of Economics and Business. She started her career in the Mergers and Acquisitions Advisory Team at Bank of America Merrill Lynch in London. She moved to Luxembourg to join the European Investment Fund's private equity investment team, where she worked in a front office role on investments into European buyout funds.
This is a very complicated bio. We need to break it down a little bit. Let's drill down into Paulina here. First of all, what does front office mean?
Well, you have front office and back office. Front office is where the execution happens of transactions, and back office is everything else.
So the front office is where you do the deal, and the back office is where you kind of process all the papers and things like that?
Front office is where you meet the clients, right?
Front office is where you meet the clients, exactly.
Of your buyout fund. What is a buyout fund? What are you buying?
Well, the fund buys. So the fund buys companies and then sells them. And the EIF, for example, is a fund of funds investor. That means that they invest in those funds.
What kind of companies were they buying then?
Oh, all sorts of companies. Companies that grow. Companies that can make money for the investors.
Okay. Best kind of companies. We love those kind of companies.
All right. Well, now Paulina works in Innovation Finance Advisory at the European Investment Bank, advising innovative companies as well as working on studies on access to finance in sectors like bioeconomy, life sciences, and circular economy.
And we're going to get to some of those terms in another podcast that Paulina is going to do for us about bioeconomy and circular economy. So watch this space on your cell phone or wherever you keep your podcast. So it's not for nothing that we included some interesting facts about Alberto the baker and Paulina the cheesemaker today. It's because everyone, as we said, has a story. There's a story to the bread, there's a story to the cheese. And it is stories that get people, in this case our listeners, interested in something. Now that works for companies too. It gets investors interested, I suppose, is what we're going to get to here. And that brings us to the subject of today's podcast. Shall we start with Paulina? What is a story when we relate it to a company? We'll break it down into equity and debt, or equity and credit afterwards. But what is the story that you're trying to tell about a company?
Well, I think in the world of investments and in the world of finance, people are concerned with returns. So when we talk about stories, we talk about what makes investments attractive. What is the story of the investment?
But is it really a story, or is it just like a resume or a CV that tells you this is the company, have a look at it, do you like it or don't you like it? Is it really a story that has a beginning and an end?
Depends how you define story. In the end, you're looking at the company, you're looking at the past, you're looking at the present, you're looking at the future, you're looking at what the company is doing, what it will do, and how you can make money off that.
Mm-hmm. And how long is this? Is this one of those what's called the elevator pitch stories? Is this like a short? Is this a short story that's you're supposed to be able to tell about your company in a minute or so as the elevator goes down?
Not necessarily. I think an equity story or a credit story can be said in an elevator, but it's a bit of a separate term. It's one of those terms that I guess bankers like to use that laymen don't really understand, but I think it's not that complicated.
Mm-hmm. So it's so that a company can tell its story and get what in return? What do they want when they tell the story?
Well, what companies typically want when they're growing is to get financing. So at some point, in most companies' cases, a company will look externally for investors. It's difficult to really grow that much from own funds. So sooner or later, most companies will look either at debt or at equity financing. So here, investors will look at whether the company has a good equity story, meaning does it make it attractive for an equity investment, basically, or does it have a good credit story?
Now, this doesn't apply just to small companies, does it? Because we've done some podcasts on small and medium-sized enterprises where we've talked about what kind of finance you get at a certain time. But a very big company would have to have an equity and a credit story.
Absolutely.
Just like a small company.
Absolutely.
Mm-hmm. So let's try and break it down a little bit. Alberto, tell us what would be the equity story.
The equity story starts from the point of view of an investor that is looking mainly to the value of the company. So typically an equity investor would like to put €1 and get out €10 out of their investments when they're going to exit this investment. So the equity story is mainly about the value of the company.
So the equity story needs to have a potential happy ending in terms of an IPO or something that the investor can see that how that €1 can turn into 10.
Yes, absolutely. I mean, obviously, if we are talking of smaller companies, yes, it's an IPO story. If we are talking about larger companies that are already listed on a stock exchange, you are hoping these companies to continue to grow and generate more value.
Mm-hmm. And with the younger companies, with the smaller companies, do we help them develop their stories?
Yes, of course. That's what, as an advisory team, we try to do. So we try to help companies to build their own stories so that they can use it with investors, externally, or even with the EIB.
Is there any kind of checklist for what should be in an equity story? For example, if you write a blog story, a journalistic story, or if you write a story, a fairy story, there's a beginning, there's a middle, and an end. Are there similar points on the equity story that we could use as a template?
Well, I don't think there is one measure fit all, but I think there are elements that you see across all the successful equity stories. So usually you would see that companies that have been able to raise equity, they usually show that there is a strong management behind the company. Another element is their market, so they can show that the market has significant growth opportunities and strong growth there. And I guess finally, obviously, because everything in the end is related to the value of the company, that they have a business plan that shows that the company can actually grow significantly. So the more profit you make, the higher is the value at the end. Mm-hmm. So it's a combination of management, so people skills, and financial skills.
But to me, when we talk about investing, it always seems that this is very black and white. It's all a numbers game, and this whole concept of stories, it seems very kind of fluffy, So, and I was really, I saw an analyst doing an example of a valuation of Tesla, and saying basically, and he was saying that the valuation of Tesla depends on the story that Tesla chooses to tell about its company. Like whether it says that their story is a technology story, or a car manufacturer story, or something else, and whether it's an upmarket story or it's a mass market story, and depending on these different story options, this analyst actually reached different valuations for Tesla's company, which to me is mind-boggling because it's still the same company, right? Yeah. And just depending on the different stories, he reached very different conclusions on what Tesla should be worth. So how is that possible in a world of black and white numbers? Well,
investment bankers use a type of valuation method called the multiples method. We're referring to the EBITDA multiple. So that's enterprise value over earnings before interest, tax, and depreciation. In short, there are different multiples in different sectors. So let's say we're looking at the automotive sector. There will be a typical multiple at which these companies trade. So let's say that 5 times EBITDA equals the enterprise value on average. When we're looking at tech companies, these typically trade at much higher multiples because they have, there's more confidence in the market that they will grow much faster, so the expectations of future value are higher. So I guess that would explain why Tesla, which is in a way an automotive company, but also really forward-thinking and innovative, may be valued higher than, let's say, Peugeot.
But the credit story is different, right? So we talked about the equity story. The credit story is something has different elements.
Yeah, I think the credit story is definitely different from the equity story. We need to think of the difference in investors that we are looking at. So usually for the equity story, we are looking at more venture capitalist or risk taker like private equity. For the credit story, we are mainly looking to banks or pension funds where they want to invest in safer investments to make sure that at the end of when people are going to retire, there is going to be sufficient money to pay pensions.
So what are the stories? What are the stories that bankers like to hear? Then they like to hear stories of cash flow, right?
Yes, exactly. I think the main difference is that the equity story is mainly based on value, while the credit story is more focused on the stability of the cash flows and profit of a company. So obviously, usually. Lenders or credit investors, they tend to be, I guess, a bit more backwards looking. So they tend to look more at what the company has done in the past as a proxy of what the company can do in the future. While equity investors are obviously looking more at the future and they don't consider necessarily the past of the company as relevant as for the credit story.
So to use the example you gave earlier when you said the equity story would be going from putting in $1 and getting 10 back,
yes.
the credit story, how would that work there? You'd be putting in the $10 and getting back 11.
12.
So you wouldn't be looking for a big payoff.
No.
So it's a more of a boring read.
Yes.
Let's say. Okay. If we keep bringing it back to stories that we actually are used to looking at. Okay. So the one thing that you've mentioned in your notes, which I thought was very interesting, because of course we should tell our listeners that the reason Allar and I sound halfway competent here is because
we have notes.
These guys gave us notes and told us what we should ask them and say to them, and so we've given away all our secrets there. But Paulina, you mentioned that historically growth and profitability are the key of the equity story. So what does that really mean, growth and profitability? How do they work in the context of that story?
Well, in financial terms, when you're talking about growth, most of the time you're talking about the growth of revenues. So let's say in year one, a company has revenues of $100. In year two, it's 105. That's a 5% revenue growth. So equity investors like to see high percentage growth over the years coming up. The other thing we are talking about is profitability, which is measured in terms of margins. A margin is basically profit or another measure of profit like EBIT or EBITDA divided by the revenues. Margins define how much money the company can make with a limited set of resources. So let's say I'm selling hot dogs and I buy them for $1 each. I sell them for $10. My margin is $9. That's great. But most hot dog stands will buy for $1 but only sell for $3. So their margin is $2. So what we're really trying to find are these companies that can buy cheap and sell expensive, or basically have low costs but be able to sell at a higher price.
Now, you've used a phrase or a term twice already, which we're going to have to look at a little bit more closely. It's almost like it's a podcast in itself. EBITDA.
Yeah.
That sounds great. So, earnings before interest, taxes, depreciation, and amortization.
Yeah.
Go. Right.
Can we have a separate podcast on that one? I
okay.
think,
All right. But so that's basically what a company makes upfront before they have to pay the taxes and deal with all their debt.
Exactly.
And all that.
Well, that's the $8 per hot dog, right? Before you start deducting the salary of the salesperson. No, the salary is already deducted, right? But everything else is not deducted yet.
Exactly.
Mm-hmm. Okay, so you guys will come back to do depreciation and amortization another time.
No,
wow. Yeah.
Just maybe I can answer this shortly. It's a really good measure of looking at the company's standing, because if you look at net profit, for example, which is after tax, there may be significant differences depending on where the company is based. A company may be paying very high taxes, and therefore the net profit is quite low. But when you're a value investor, so an equity investor, in the end, tax, depreciation, amortization are not that important to you. So you're looking at the earnings before accounting for those variables.
Is there a parallel, Alberto, in the credit story to that question of the margins? If you're in a private equity investor, you want to have a big margin. What's the equivalent for our more boring credit story?
Well, I mean, obviously the EBITDA, since we have introduced this complicated term.
Yeah, let's go with it.
Is important also for lenders because it's a measure to understand the ability of the borrower to repay the loan. So obviously it's really important also for lenders. I think what lenders would probably look, and this is probably different from an equity story, is more looking at the current EBITDA rather than the expected EBITDA. So they tend to look at what the company has been able to achieve today rather than what they are going to achieve in the future.
So it seems to me that the credit story is more like a story that would begin with once upon a time, and an equity story is more like a dream, looking
of.
forward, right?
Kind of, yes.
In a galaxy far, far away.
Yes. It's just like a science fiction story, if we're doing stories.
I think there's also one more difference between the two stories that is worth mentioning, which is the risk and the return. So equity investors are buying shares in the company. They are really invested. So they have a very high risk and they have high return expectations. Whereby a bank or a lender is simply lending money to the company, which is much less risky, in fact, than buying shares of that company.
But does that risk change the story in the sense that, again, let's bring it back to stories that people actually tend to sit and read. You can have a very exciting story that's quite short and there's not maybe that much detail in it, but the narrative takes you through and makes you feel excited. But then if you want to read a history or a biography, it might be 800 pages and it's got all the letters that this guy wrote to that guy and all the details in it. So is a credit story a lot bigger and longer?
Well, I think what the way probably you can look at it is that the equity story is the first chapter of your book, while the credit story comes later on, is probably chapter 10 of your book.
Yeah, that's a nice parallel.
Great. Okay.
So I think we understand these stories a lot better now.
Absolutely. Thanks for telling us the stories, Paulina and Alberto.
Thank you for having us.
Thank you.
And they lived happily ever after.
You still think that's how equity stories and credit stories end?
Sure. I have a lot of faith in the economic future of Europe. Meanwhile, we'd love to hear from our listeners with their ideas for future episodes of our podcast. You can write a fairy story and post it as a thread of tweets to @EIBMatt, M-A-T-T.
Or you can write an exciting thriller in chunks of 140 characters and post it to @Allar, ALLARTANKLER.
Or you could just write a regular sort of tweet if you're a traditional type. We'll be happy to hear from you anyway. All stories are good fun.
And see you next time on A Dictionary of Finance.